A private room in a nursing home now costs, on average, about $130,000 a year. You heard that right. This is the yearly cost. Assisted living runs somewhere around $70,000 to $75,000. Bringing an aide into your own home, full-time, lands in that same neighborhood. And here's the part that turns a scary number into a genuine crisis. The typical stay isn't a few weeks. It's often 2, 3, 4 years. So a single episode of long-term care in this country can easily cost $300,000, $400,000, sometimes far more. That's a house. That's an entire life savings, gone. And Medicare, the program you paid into your whole working life, the program most people assume will catch them, does not cover this. I want to be very clear about that because it's the single most dangerous misunderstanding in all of retirement. Medicare pays for short-term recovery. It'll cover rehab after a hip replacement for a little while. But long-term custodial care, the ongoing daily help with bathing, dressing, eating, and moving around that most of us will eventually need, Medicare pays essentially none of it. That gap, that enormous, terrifying gap, is where families get financially destroyed. So today, I'm not going to just frighten you with that number and leave you there. I'm going to do the opposite. I'm going to show you 6 real practical ways that families actually pay for long-term care without going broke, without handing over the house, without wiping out the savings meant for a healthy spouse, without leaving nothing behind. Some of these you've heard of and misunderstood. At least 2 of them, I'd bet most of you have never heard of at all. And the 6th one is the safety net almost nobody understands correctly, the one that has protections built into it specifically so that one spouse's illness doesn't impoverish the other. Here's something to hold on to before we even start, because it reframes this entire conversation. Roughly 7 out of 10 people turning 65 today will need some form of long-term care in their lives. 7 out of 10. This is not a rare misfortune that happens to other families. This is the base case. It is, statistically, what happens, which means the question was never, will this happen to me? The question is only, will I have a plan when it does? The families who go broke are almost never the ones who got unlucky. They're the ones who had no plan. So let's build you one. Let me give you a couple to follow through all 6 of these. Call them Harold and Ruth, both 74. They've got a paid-off house, a modest amount in savings, Social Security, and a small pension. Comfortable, careful, ordinary. And Harold has just started showing the early signs of needing real help. Ruth is terrified, not just for him, but about whether taking care of him is going to leave her with nothing. Their fear is the fear of millions. Let's walk them through the options, and you'll see there are more of them, and better ones, than most people ever realize. Way number 1 is the one most people think of first, and it's a genuinely good tool if you get to it in time. Long-term care insurance. Here's the simple idea. Just like you insure your house against a fire, you can insure yourself against the risk of needing years of expensive care. You pay a yearly premium while you're healthy, and if the day comes when you need help, with those daily activities at home or in a facility, the policy pays out a set amount, often a few $100s a day, to cover that care. It is the most direct way to transfer this enormous risk off of your family's shoulders and onto an insurance company's. Now let me give you the real numbers, honestly, because this is where people need the truth. If you buy a policy in your mid-50s to early 60s, which is the sweet spot, a healthy person might pay somewhere in the range of $1,200 to $2,000 a year for a solid policy. Buy it as a couple, and you often get a meaningful discount. Now compare that to the alternative, paying premiums of, say, $1,900 a year from 60 to 85 adds up to under $50,000 over 25 years, while a single year of nursing home care is $130,000. If you end up needing even 1 year of care, that policy has more than paid for itself many times over. That's the whole bet, and for a lot of families, it's a smart one. But I promised you honesty. So here are the catches, because this tool is not for everyone. First, it's use it or lose it, like car insurance. If you never need care, those premiums are gone, and that bothers people. Second, and this is critical, you have to be healthy to qualify. You cannot buy this once you already need it, or once you've developed the conditions that lead to needing it. That door closes often in your 60s. So this is a tool for planning ahead, not for a crisis. Third, premiums on older policies have sometimes gone up over the years, which has burned people. And fourth, you want a feature called inflation protection so that a policy you buy today actually keeps pace with what care will cost 20 years from now. For Harold and Ruth, this ship has partly sailed. Harold's already showing symptoms, so he likely can't qualify now. But Ruth is still healthy, and this is the lesson buried in their story. The best time to consider this was 10 years ago, and the second best time is today, while you still can. If you're watching this and you're in your 50s or early 60s and healthy, this is the way that's most available to you and least available later. Don't let it quietly expire. Way number 2 solves the single biggest complaint people have about traditional long-term care insurance. That use it or lose it problem. It's called a hybrid policy, and it has become one of the most popular tools in this whole area, for good reason. Here's how it works, and it's clever. A hybrid policy combines life insurance with long-term care coverage into one product. So you put in a chunk of money, either a single large payment or premiums over time. And here's the magic. If you end up needing long-term care, the policy pays for your care. But if you never need care and you pass away, your family receives a life insurance death benefit instead. Either way, the money does something. Either way, somebody in your family benefits. Nothing is wasted. That's the emotional hook, and it's a powerful one because it removes the gamble that makes people hesitate on traditional coverage. For someone who has, say, $100,000 sitting in a CD or a savings account that they've mentally earmarked just in case, money that's just parked there earning a little interest, repositioning some of that into a hybrid policy can turn it into a benefit pool worth 2, 3, sometimes 4 times as much if care is needed, while still guaranteeing the family gets something if it isn't. It's a way of making that just-in-case money work much harder. The honest trade-offs. Hybrid policies cost more upfront than traditional coverage. You're often talking a substantial lump sum, so you need to have that money available to reposition. They may not have inflation protection as strong as a dedicated policy, and the long-term care benefit, dollar for dollar, is sometimes smaller than what a pure long-term care policy would give you for the same money. But for the person who hates the idea of paying for something they might never use, and who has a lump sum they can move, hybrids have genuinely solved that problem. They're worth a serious look. Way number 3 is one that most families have absolutely no idea exists, and it makes me a little angry, honestly, because it goes unclaimed by hundreds of thousands of people who earned it. If the person needing care is a wartime veteran, or the surviving spouse of one, there is a benefit called aid and attendance. Let me explain, because this is real money. The VA has a pension benefit, and built on top of it is an enhancement called aid and attendance, designed specifically for veterans and their spouses who need help with the activities of daily living. And the amounts are meaningful. In 2026, a married veteran who qualifies can receive a maximum of around $34,000 a year, nearly $2,900 a month, tax-free, to help pay for care. A single surviving spouse who needs care can receive well over $1,000 a month toward it. That is money that goes directly toward the cost of an aid, or assisted living, or a nursing home. To qualify, the veteran generally needs to have served at least 90 days of active duty, with at least 1 day during a designated wartime period. And that covers an enormous number of the veterans in this audience. World War II, Korea, Vietnam, the Gulf War, there are income and asset limits, but here's the crucial part that mirrors what we'll see later. Your unreimbursed care costs get subtracted from your income when they figure out if you qualify. So a veteran paying $5,000 a month for assisted living, who looks too wealthy on paper, may qualify easily once those care costs are counted. Do not disqualify yourself in your own head. The tragedy of this benefit is simply that people don't know it exists. The overwhelming majority of those eligible never claim it. So if you or your spouse is a wartime veteran and care is on the horizon, this is worth a phone call today. And here's the most important safety tip. Get help from an accredited Veterans Service Officer through your county or a group like the VFW, the American Legion, or the DAV, and they help you for free. Never pay one of the companies that charges a fee to file this. The good help costs nothing. Way number 4 is about using the largest asset most retirees own, the one they're often sitting right inside of, the home. For most families, the house is the single biggest pool of money they have, often far bigger than their savings account. And when care is needed, that home equity can become a genuine lifeline. There are a few ways families tap it. The most straightforward is simply selling the home, especially when someone is moving permanently into a facility and the house is going to sit empty anyway. That can free up $2, $3, $400,000 to fund excellent care for years. But what about when one spouse needs care and the other still wants to live in the house? Nobody wants to sell the home out from under a healthy spouse? That's where other tools come in. Some families use a reverse mortgage which lets a homeowner 62 or older pull cash out of their home equity while continuing to live there. It can create an income stream to pay for in-home care for one spouse while the other stays put. Now, reverse mortgages are complex and they have real costs and downsides, so they need to be understood carefully and are not right for everyone. But for the specific situation of keeping one spouse at home while funding care, they're a tool worth understanding. Others use a simple home equity line of credit to bridge shorter-term costs. Here's the honest guidance on this. 1. The home is powerful precisely because it's usually the biggest asset, but it's also emotional and it's often what people most want to preserve for their children. So the key is to be deliberate. Decide in advance what role the house is meant to play. And know this, which we'll come back to in a moment. The home has special protections under the Medicaid safety net. It is generally not counted against you while a spouse still lives there. So don't rush to sell it in a panic without understanding those protections first. Sometimes the smartest move is to keep it, not sell it. Way number 5 is less a single tool and more a strategy, and it's the one that separates families who weather this from families who get wiped out. I call it the income and buckets approach, building a deliberate plan out of the money you already have before the crisis hits. Here's what I mean. Most people, when care hits, just start bleeding money out of one account until it's gone. Then the next, in a panic, with no plan. The families who do this well do the opposite. They sit down, ideally years ahead, but even in a crisis it helps. And they take inventory. What guaranteed income comes in every month? Social Security, pensions, any annuities. That income doesn't stop when care starts, and it can cover a real chunk of the cost. Then they look at their savings and they mentally divide it into buckets. This bucket is earmarked for care. This bucket is protected for the healthy spouse. This bucket is for everything else. One specific tool worth knowing here is an immediate annuity. In the right situation, a family can take a lump sum of savings and convert it into a guaranteed monthly income stream for life, which can be used to reliably cover care costs. And, as we'll see, has special uses within Medicaid planning too. It essentially turns a scary pile of money you're afraid to spend down into a dependable paycheck. The deeper point of way number 5 is this. The difference between the family that goes broke and the family that doesn't is very often not how much money they had. It's whether they made a plan with it. Two families with the identical $200,000 can have completely different outcomes. One spends it in a frightened blur and ends with nothing. The other maps it out, combines it with income and the other tools on this list, and makes it last for years while protecting the healthy spouse. Planning is the multiplier, and the single best thing you can do is talk to a good elder law attorney or a fee-only financial planner before the crisis, because the moves that protect you take time to set up. Which brings us to way number 6, the safety net underneath everything else, the one that is most misunderstood, most feared, and most important that you understand correctly. Medicaid. Now, I know, for a lot of proud people who worked and saved their whole lives, the word Medicaid brings up discomfort. It feels like welfare, like failure, like something for other people. I want you to set that feeling aside, because here is the reality. Medicaid is the largest payer of long-term care in the entire country. Roughly 2 out of 3 people in nursing homes are on it. This is not some rare fallback. For millions of ordinary middle-class Americans, this is simply how long expensive care eventually gets paid for after other resources are used. There is no shame in it. It is part of the system you funded. Here's how it works. Medicaid will pay for long-term care, including nursing home care, but only for people with limited income and assets. For a single person, the countable asset limit is famously low, typically around $2,000. So people assume that means you have to be completely destitute, that you have to lose everything, and that assumption is what causes families to make terrible, panicked, and completely unnecessary decisions. Because here is the part almost nobody understands, and it is the heart of this entire video. When you are married, and one spouse needs care while the other stays home, The law has powerful protections built in specifically to prevent the healthy spouse from being impoverished. They're called the spousal impoverishment rules, and every family facing this needs to know they exist. Let me give you the actual 2026 numbers, because they're a great deal more generous than people fear. The healthy spouse who stays at home, Medicaid calls them the community spouse, is allowed to keep a chunk of the couple's assets all to themselves, ranging, depending on the state, from about $32,000 up to as much as $162,000. On top of that, the family home is generally protected entirely. It does not count and cannot be taken while the healthy spouse is living in it, with home equity protection up to at least $750,000. One car is protected, personal belongings are protected, and the healthy spouse gets to keep enough of the couple's monthly income to live on. In 2026, a minimum floor that can rise to about $4,000 a month, so they're not left with nothing to pay their own bills. So look at what that actually means for Ruth. The nightmare in her head was, Harold's care will take everything, the house, all of it, and I'll be left destitute. The reality is, the house is protected while she lives in it. She keeps her car. She keeps a substantial slice of their savings for herself. She keeps enough of their income to live on. Medicaid steps in to pay for Harold's care after their combined countable assets are spent down to the limit. But spent down doesn't mean spent into poverty, and it doesn't touch the protected share that keeps Ruth secure. That is a fundamentally different and far less frightening picture than the one most people carry around. Now, two honest and very important cautions on Medicaid, because getting these wrong causes real damage. First, there is a 5-year look back. Medicaid examines everything you gave away or transferred for less than fair value in the 5 years before you apply. So you cannot simply hand your money and your house to your kids the month before applying. That triggers penalties. This is exactly why the planning has to happen early, ideally more than 5 years ahead, and why the do-it-yourself version backfires so often. Second, Medicaid has something called estate recovery, where after death the state may seek to recover what it paid from the person's estate, including sometimes the home. There are protections and exceptions, especially for a surviving spouse. But it's a real thing you need to plan around. And this is my strongest piece of advice in this entire video. For anything involving Medicaid, see a qualified elder law attorney. Not a general lawyer, not a salesman, an elder law attorney who does this every day. The rules vary enormously by state. They're genuinely complex, and there are completely legal, legitimate strategies, like certain kinds of annuities, like properly structured transfers done in time, like partnership insurance policies that let you protect extra assets, that a good elder law attorney can use to protect far more of your family's money than you'd ever manage alone. People hear attorney and think expensive, but spending a few $1,000s on the right attorney routinely protects a few $100,000s of a family's savings. It is very often the highest return money a family in this situation will ever spend. Let me pull all 6 back together, because the real secret is that these are not 6 separate choices where you pick one. The families who truly don't go broke usually combine them. 1. Long-term care insurance if you're healthy enough to get it. The Plan Ahead tool. 2. A hybrid policy which solves the use it or lose it problem and makes your just-in-case money work either way. 3. The VA's aid and attendance benefit, real tax-free money for wartime veterans and their spouses that almost nobody claims. 4. The home, your largest asset, tapped deliberately through sale, a reverse mortgage, or a line of credit, and protected under Medicaid while a spouse lives there. 5. A deliberate income and buckets plan built from the money you already have, so care gets paid for methodically instead of in a panic. And 6. Medicaid, the misunderstood safety net, with its powerful, generous protections that specifically exist to keep one spouse's illness from impoverishing the other. A real family's plan often looks like this. Insurance or a hybrid policy covers the first stretch. The veteran's benefit adds a tax-free monthly boost. Income and a portion of savings fill the gap. And when a long stay eventually exhausts the money set aside for care, Medicaid steps in, with the house, the car, and a healthy chunk of assets and income still protected for the spouse at home. That's not going broke. That's a plan. That's the difference. Let me make that concrete with Harold and Ruth. So it's not just theory. Say Harold ends up needing assisted living then a nursing home over about 4 years. A bill that left unplanned could top $400,000 and terrify Ruth into thinking she'll lose everything. Here's how a plan changes it. Ruth's still healthy, so she'd bought a modest hybrid policy years back on herself. Harold's care they handle with the tools that fit his situation now. First, because Harold's a Vietnam veteran, they claim aid and attendance, roughly $2,000 a month, tax-free, that they never knew existed, knocking a big piece off the bill from day one. Their Social Security and Harold's small pension cover another large chunk of the monthly cost. They earmark one bucket of their savings for care and let it do its job. And when, in year 3, that care bucket finally runs dry, Medicaid steps in to cover the rest. While Ruth keeps the paid-off house she still lives in, her car, about $150,000 of their savings that the spousal rules protect for her, and enough of their monthly income to pay her own bills. 4 years of care paid for, and Ruth is still secure, still in her home, still okay. Same crisis, completely different ending. That's what a plan buys you. Before I wrap up, let me address something that's on a lot of your minds. Because for most families, the very first way they use isn't on my numbered list at all. A family member simply provides the care themselves. A spouse, or more often an adult daughter, quietly becomes the caregiver. And I want to say 2 honest things about that. First, it is an act of profound love, and it saves families staggering amounts of money. Unpaid family caregiving is the invisible foundation holding this whole system up. But second, it is not free, and pretending it is does real harm. That caregiver often cuts back at work or quits, losing income and their own retirement savings and Social Security credits. Their health frequently suffers, and burnout is not a maybe, it's a near certainty when one person tries to do it all alone. For years. So if this is your family's path, do 2 things. Look into whether the caregiver can actually be paid. Some states and some VA and Medicaid programs will pay a family member to provide care, and a good elder law attorney can tell you how to set that up properly. And build in respite care from the start. Regular breaks where a paid aide or an adult day program steps in, so the family caregiver doesn't destroy their own health and finances in the process. Loving someone by caring for them should not require going broke or breaking down yourself. Fold it into the plan. Don't just let it happen to you. Now let me be honest and careful with you, the way I always try to be. Because this is serious, and every family is different. All of these numbers are current for 2026, but they change every year, and the details, especially the Medicaid rules, vary a great deal from state to state. Not every tool fits every family. What's right depends on your health, your age, your assets, your marital situation, whether there's veteran service in your family, and the state you live in. So please take this video as your map of what's possible, not as your specific instructions. The specific instructions come from sitting down with the right professional, and I've told you which ones: a fee-only financial planner for the money side, and above all, a qualified elder law attorney for anything touching Medicaid. Here's the thought I most want to leave you with. The reason long-term care destroys so many families financially is almost never that the money wasn't there. It's that nobody made a plan for it. And so when the crisis came, in the worst and most emotional moment of their lives, they made frightened decisions with no map, and they spent everything because they didn't know they didn't have to. You now know that you don't have to. You know there are 6 real doors, not 0. You know the healthy spouse is protected far more than you feared. You know there's tax-free money sitting unclaimed for veterans, and insurance that pays either way, and a safety net with your name already on it. The families who come through this with their security and their dignity intact are not the rich ones, and they're not the lucky ones. They're the ones who learned what you just learned, and who made a plan before they needed it, or who at least knew when the moment came that a plan was still possible. So don't wait for the crisis to start learning this. Have the conversation now, at the kitchen table, while everyone's healthy and calm. Talk to your spouse, talk to your kids, and talk to a good elder law attorney before you need one. Because the goal here was never just to pay for care. The goal is to pay for care and still have a life, a home, and a secure spouse on the other side of it. And now you know that isn't just a hope. It's a plan you can actually build.